Okay, so in the last screencast videos and the videos of the lecture that you see too, I've gone through the accounting cycle, right? There's a process flow to how business transactions are entered and recorded into the accounting books. And we went through that accounting cycle, the 10 different steps there of how we do it. And so you understand the overarching flow, the overarching cycle. And now in these next few videos, what I'm going to do is go through each one of those steps in a little more detail, so that we can understand what constitutes a transaction, your journal entries, and then really spend a little bit of time on debits and credits and talk about that. So yeah, the first part, the first one in the cycle is recognizing a transaction. When did a transaction take place? And usually transactions are initiated through some document, some form of documented request, an invoice or a bill or a contract or something like that, right? And so we put those into the file. We'd have that contract saying, here's how it was initiated, and then we enter it either as an obligation, enter it as obligation, and either we pay it or it's entered either as a payable or a cash disbursement or as revenues, right? So either it's an obligation saying, well, we know we have this bill from the gas company, but we're going to pay those at the end of the month or something. So we entered it and we put it into accounts payable, right? Then once it's paid, it goes out of accounts payable and then becomes a cash disbursement because we actually goes out of our cash account. We cut a check or wire the funds or something like that. So it's either an obligation, a payable or receivable, or it's a disbursement like that, or it's revenues where we get we got money in from a sale or something, right? So either we receive money as a revenue or sales, or we pay money as expenses. Those are the two things. And then in accrual accounting, we also have the other options of we're owed money, an account receivable, or we're obligated to pay money. We have an account payable. And those accrued accounts are generated because we want to follow the matching principle, right? We want to match an expense with a revenue or a payable with an obligation so that we know exactly when these hit our transactions, so that we can make more sense of our books, make more sense of actually how our transactions affect the company. Otherwise, you might say, well, we got some money in, we sold something and we paid for that. Say we prepared it. We're a bakery. We prepared a giant cake and we gave it to the bride, the wedding party, and they promised to pay us in 60 days. Well, we already incurred the expenses for making that cake and all the ingredients and everything, but we haven't actually gotten the money in. And so if we don't have an account receivable that indicates at that time that money should match up with that payment, then say in 60 days when we do get paid, all of a sudden we get all this money in and there's magically no expenses that were matching with that in that period. And in the current period, we had the expense for making the cake, but we have no revenues to offset against the making of the cake, so our expenses look high. That's why accrual accounting comes along and we generate these different accounts, the accounts receivable and accounts payable and things like that. So that's transactions, and next I'll be back with turning those transactions into actual journal entries. So I'll see you in a minute.